This is Ken Lake with a technical market update for Friday, December 9th. I'm going to start with March soybeans or old crop soybeans tonight. And notice that the market's retraced 65% of what it lost from last summer's highs to this fall's lows. The recommendations I've had out for weeks now has said that if we get back to this 50% line, that we should go ahead and sell our old crop beans. I haven't changed my opinion about that, except that those of you who do still have soybeans left could certainly hold these things for South American weather market. We haven't seen it develop yet. There are a couple of dry spots in southern Brazil, some in Argentina, that could play over the next few weeks, but to hold old crop beans beyond this point is to speculate on that weather issues in South America. Otherwise, we've done just about all we would expect soybeans to do in the light of the fact of the crop size that the U.S. has recently seen. I want to switch over to November soybeans, November 17 soybeans. In this chart, we made new contract highs in the last couple of weeks in the 1040 and the 1030 range. Customers should be selling soybeans in these ranges. It's pretty close to $10 cash soybeans in most places in the state of Michigan, so there's no reason that we shouldn't be hedging some of these in here. Certainly, if we have a weather problem in South America, we might push this thing a little higher, but we need to get some hedges done for 2017 nevertheless. I'm going to talk a little bit about corn, and the point we're going to make in corn is that we don't think that we need to sell corn in here. It's not that we're completely bullish corn, it's just that when you take a look at corn, especially on a long-term chart, I'm going to have a monthly view here. You'll notice at this point corn is trading in the bottom 25% of its trading range over the last 15 years. When you switch to soybeans and take a look at that, we're trading in about the 50 percentile range in soybeans. So soybeans are trading 50% of their trading range over the last 15 years. So a much better sale in soybeans than corn. So even though there's still some corn bears out there, there's lots of corn around, farmers aren't moving cash corn, so there could be some reasons to stay friendly corn. The recommendations that I had given based on the March corn contract is that we should wait for futures to retrace about half what we lost last fall. Similar advice that we gave in the soybeans. We saw the soybeans make that move. We haven't seen the corn make that move at all. The world is clearly awash in corn. So rather than be bullish enough to think that we're going to trade 380, we might be in better condition if we think in terms of this 375 mark. 375 is a 30% retracement of that move from last summer's high to this fall's low, and then coincides with a 200-day moving average here and makes a little more sense to make sales at that point. We don't think we have to sell corn today in these ranges, and we would be comfortable waiting for about another 20 cents higher in corn.